All right, good evening, everybody. My name is Larry Ward. I'm the governor for Southeast Pennsylvania for the American College of Physicians. Thank you for joining us. We do have a good number of people, which is good, and hopefully more people will join. Given everything that's going on, I appreciate you taking the evening to join us. We think that this is still a interesting topic that people will enjoy hearing about. We are going to record it for posterity and put it up on our website so that others can see it if they weren't able to this evening. And it'll be up there for 1 year so that we keep it in a not getting dated and overly keep it in a timely manner. We're happy tonight to have Michael Clancy, who is the Director of Financial Planning for the Drexel University College of Medicine. He has spoken on a lot of financial issues specifically related to physicians, and we thought that he would be an especially good speaker for talking to you tonight about personal financial planning. And I think a lot of what he's going to talk about you'll find very practical and useful and helpful for whether you're a medical student, a resident, a fellow, or an early career physician, or somebody farther along in their career. So with that, Michael, thank you for joining us, and I'll turn it over to you.
Hey, thank you very much, Larry. Well, good evening, everyone. Let's get my screen here. There we go. We had a little bit longer of a program envisioned, but for tonight, we're just going to basically chop down to 3 areas. I focus primarily on student loan related issues as well as financial planning issues. So for tonight, we're going to talk about student loans initially. I want to talk about insurances because as a physician, you will be pitched insurance from insurance salesmen constantly. You need to understand what it is, how it works, so that way you can better evaluate it, because it is a high pressure sales approach. I'm going to talk about investments. This is kind of a portion of what I call beginner investments for everyone. I'm not really focusing on the stock market this past week, but definitely you'll get a sense of how you should approach your own investments going forward. Now, as far as student loans, I deal with very, very high dollar student loans, so it's always such a what I'll call a burden, but people need to understand how things work so that they can figure out what the right strategy is for them. Generally, there's 2 big classifications of student loans. We got our federal student loans, and we have our private student loans. But even within the federal, there are what are known as direct student loans. These could be direct graduate plus, direct Stafford, and so forth. Or for some of you, you might have some Perkins or health professions loan, or some of you more seasoned professionals might actually have some non-direct Stafford and plus loans from the earlier years. If we have non-direct federal loans, you could consolidate them into a direct consolidation loan. And I'll talk about the features of that in a second. But generally with federal, we've got direct and non-direct. Now, with repayment on federal loans, there are multiple payment plans to choose from. Standard, generally, you can't afford it, but you're on that plan by default. It's a 10-year payment plan, so it tends to be a very large payment. So generally coming out of a med school environment during your training years, it's not something you could generally afford. Graduated is it's a 10-year plan, starts a little low and it gets higher than standard. So again, not affordable. Extended, that's what the attendings and those further into their career, that's what they chose coming out of their training years ago. They did not have the choices that current graduates do have. But you can see on the bottom there, I'm listing what's called income-driven repayment plans. The ones above it are straight amortization. Your payment is interest and principal. But income-driven plans, the payment is based off of your income. There are multiple income-based plans to choose from. ICR was one of the older ones. It's 20% of your income. IBR, income-based repayment, 15%. Pay-as-you-earn and revised pay-as-you-earn are relatively newer plans. It's based on 10% of your income. Now, the reason why we look at income-based plans is maybe we're working towards what a program called public service loan forgiveness. It's in the news a lot. There's a lot of misunderstanding. There's a lot of customer service issues related with it. But I'm going to talk about public service loan forgiveness for a second, because everyone generally comes out of med school focused on it, and then maybe their career takes them off path towards it. With public service loan forgiveness, there are 3 very strict criteria. It's only eligible on direct federal loans. So earlier when I mentioned that there are non-direct loans, how we could remedy that is by doing what's called a direct consolidation loan. It takes that non-direct federal loans and makes them eligible. If you have a private loan, that's not eligible. If you have a loan from your friend or your parents, relatives, not eligible. If you have a loan from a bank, not eligible. Even if you have a loan from your undergrad or graduate program, not eligible. Only direct federal loans. Now, you also need to be on a qualified repayment plan. So when I mentioned those different plans, all the income-driven plans are qualified payment plans. Standard is also qualified, but it pays the loan off. There's nothing left to forgive if you're on standard. The third criteria, and this is the most sensitive, you need to work full-time for a nonprofit, specifically a 501c3 nonprofit, or a government. Could be state, could be federal, could be local. If we're doing locums, if we're doing agency, contractor work, if we're in a private group as an employment setting, those do not count. So think about your own career path. Think about that employment setting that you see yourself practicing in. Are you employed by the hospital, or are you a group that has privileges at that hospital? Who's the employer? So it has to be a 501c3 nonprofit or a government. So again, we could go work for the VA hospital. We could work for a local municipal hospital. If we could move, if we had a state-related institution, those would count under the government. Or are we working for a nonprofit health system, possibly an academic group or something like that? You need to make 120 monthly payments on a direct loan on one of the eligible payment plans while you're working full-time for a nonprofit or government. Now, their definition of full-time is on average 30 hours or more per week. You can still moonlight on the side. You could do locums on the side. That would not negate the fact that you have a full-time job that's eligible. One misunderstanding is the payments do not need to be consecutive. So maybe we're working for a few years during our residency time period. Maybe we do a 1-year fellowship someplace that's not eligible, but then we start working again for an eligible employer. We made payments during that ineligible time period. Those payments simply do not count towards the 120 requirement, but the clock doesn't reset. It starts right back up where it left off. And it may take someone 11 or 12 years to actually make 120 monthly payments to count. Now, for those of you that have made loan payments in the past, look back at your work history. Were you on one of the eligible payment plans during that period of time? Do you have any non-direct loans that you were making payments on? Again, those non-direct loans were not eligible at all. Payments you made on those non-direct loans do not count towards public service loan forgiveness. Did you go on a period of forbearance for any point in time? Could be for 6 to 12 months, could have been simply a 1-month, what they call administrative forbearance, while your payment got recalculated. Did you make payments on time? If it was late, then that month would not count. There's also a trap that most people are not aware of. It's called paid ahead status. What that means is when you're making a payment above your minimum, or you send in a lump sum in 1 month, what that amount covers is your payment for that month, sure, but it's also prepaying the next couple months. For example, if you have a monthly payment of $300 a month and you hypothetically send in $1,000, yep, it makes your payment for that month, let's say March, but it's also paying your April and your May payments and a portion of your June payments ahead of time. It's called paid ahead. Now, when you get into the months of April and May, even though you may make your regularly scheduled payment during that month, there officially was no monthly payment. So therefore that month would not count towards the 120 requirement. I'll run into this a lot when someone is receiving loan repayment dollars. It could be from the NIH, it could be from National Health Service Corps, it could be from their employer, or they got a lump sum per their contract and they throw it all at their loans. They're actually wiping out future payments, qualified payments, without even knowing it. So if you feel that you might be in pay-to-head status, or even if you don't know, I would suggest people contact their loan servicer and request to be taken out of pay-to-head status, so that way we don't accidentally, trip ourselves up if we're working towards public service loan forgiveness. Now, I have seen plenty of physicians with loan repayment assistance as part of their contracts or as a form of an employee benefit. This is just simply where an employer is giving you extra dollars each month to put towards your loans. It's a recruitment incentive that I'll see, especially with rural health systems. Now, money that you're receiving from your employer is taxable. So for example, if you're receiving $1,000 a month from your employer to go towards your loans, that is inflating your income that year by $12,000. And when you recertify on your monthly loan payment each year, it's going to take that into account and your monthly payments will be higher the following year. Now, some of the government ones, especially National Service Corps, those are not taxable if we are receiving that. So again, if we're on track towards public service loan forgiveness, did we really need that loan repayment assistance from our employer? Could you pocket the dollars rather than applying them towards your loans? Some employers might require proof that you applied the money towards your loans and others might not. Remember about the whole pay-to-head status I talked about if you start putting those extra money towards your loans. Also, does it extend your contract? You might have a 2-year contract with a medical group or a hospital system, but if you take them up on the loan repayment assistance, it might actually extend your contract, something like that. So we have to be conscious of that. I mentioned about consolidation earlier. There's a way to take your non-direct federal loans and make them direct. If you have multiple loan servicers, now you're down to one loan servicer. For those of you coming out of your medical school, if you do consolidate, it will cut off your grace period. So if you're looking forward to having 6 months of no payments after graduation and you consolidate, you go right into repayment sooner. If you had made payments previously, whether it's during your residency years or a gap year before med school, and those payments had counted towards loan forgiveness, if you consolidate those loans, it resets the clock. You're back at month 0 again. So you always want to look at your employment history and your payment history before you consolidate. Now, why do we talk about the different payment plans and loan forgiveness? Let's say hypothetically we borrowed $250,000, we've got a starting residency income, and we have a starting attending income. If we're on standard, the monthly payment would be $3,200. Definitely can't afford that as a resident. If we're on IBR, that's that 15% of income based on that residency income, your initial payment for the first year would be $468, and that would slowly rise during your training years. But now that you jump to an attending salary, the payment jumps up to about $2,200, $2,300, and over time gets higher as your income rises. Pay-as-you-earn and revised pay-as-you-earn are that 10% calculation. So you can see the math is lower. Again, residency years would start in the 300 range, the attending years would start in the 1500 range, and they would grow over time. Now, there are some differences between pay-as-you-earn and revised pay-as-you-earn, even though mathematically they're the same number. Pay gets canceled after 20 years of payments. Repay goes out to 25 years. So you can see on the back end there, it just kept going higher and higher and higher. Now again, extended, that was an option that's available to you. It's not an income-based option. It's basically extending the loan repayment over a longer period of time. But you can see mathematically, it's still a very high payment for a resident to start out on. Pay-as-you-earn has a ceiling to it. So even though your income goes higher, it didn't go any higher than that 2541 number. So these are all different factors that I weigh when I talk with someone about what's the right repayment plan for them. It could be based on their specialty, it could be based on their training years, household income, household size, all those different factors. Now, again, same scenario, how much are we paying towards our loans? Well, standard, that was the 10-year fully amortized, you paid the whole thing off, $389,000. IBR goes out further, smaller payments, but it goes out longer. We're actually paying more than standard, but then again, we couldn't afford standard earlier on. Pay and repay, much smaller amounts, but repay goes out further. Extended, again, we're dragging it out longer, so it costs us more. Pay and repay, IBR as well, but pay and repay, pay got canceled after 20 years. The remaining balance, you've already paid $417,000 out of pocket, but what was left over after 20 years on this career was about $225,000. That amount gets canceled, and you pay tax on that amount. A rough rule of thumb would be 40 cents of every dollar, so you're looking at about an $80,000 or so tax bill just from that alone. Repay goes out further, so you're paying more, but whatever the balance is at that point also would get canceled, and you would pay tax on that as well. Now, why does everyone focus on public service loan forgiveness? Same scenario here. Standard was an eligible payment plan, but you paid the whole thing off, so there's really nothing to be forgiven. IBR, in the first 120 months, this graduate would have only paid $230,000, yet there would still be a balance after 10 years or 120 months of $234,000. The forgiveness amount on public service loan forgiveness is tax-free. When the loans are canceled under the payment plans, that's a taxable number, but on public service loan forgiveness, it's tax-free. Now you can see with pay and repay, mathematically, it's the same dollar amount. And the assumptions for this is that you're single, so we only have one income factored in. But in the first 10 years, this borrower who borrowed $250,000 only pays back $153,000. You can see the remaining balances. Repay has a subsidy to it, so that's why its ending balance is lower. But again, what was out of pocket was the payments were $153,000, way less than this borrower actually borrowed. And again, extended didn't count, so there is no forgiveness with extended. Again, what we're paying back towards our loans is actually less than what we borrowed. So your career path determines this. It really depends on what your employment setting is. And I work with a lot of graduates when they want to evaluate their contracts and their different job offers. Let's say job A counts or is qualified towards public service and job B does not. Well, what career path does job B put them on? You're going to have factors such as geography, potential for partnership, autonomy, hours, schedules, commuting distances. And there's a lot of non-financial factors that go into a job offer, but one of them could be, does this job qualify for public service loan forgiveness? And if so, what would that remaining amount be that you're forgiven versus how much of the loans have you paid? So a lot of the discussions always focus on public service loan forgiveness. Now, if someone has private loans, their payments are not based off their income. They are not eligible for public service loan forgiveness. So when we evaluate someone that has private or institutional loans, the factors are going to be the more traditional way to look at debt, such as what's the interest rate, how long are these payments required to be made, what's our monthly obligation, can we afford it or not, are there any deferment options, whether we're extending our training years, or if we're out on family leave, or if our income drops, what are the cancellation options, if at all, and are there any service obligations that come with those loans? So private loans, we evaluate more traditionally. Federal loans, it's kind of what's the career path we're on, what payments could we afford, is there the potential for forgiveness? Now with the private loans, obviously you have to make your minimum payment every month. If you overpay on those loans, you're going to pay it off faster and you will save interest. Maybe we want to look at possibly refinancing those private loans. could we get a lower interest rate, or could we get a lower monthly payment obligation? Is maybe we're starting a family, maybe we just bought a house, maybe we need a payment that fits our budget, and with our existing loans, we can't do it, where we have a tight budget. Maybe we need to finance to a longer term so that we have a lower monthly payment. If we refinance to a shorter term, the payments will be larger, but you will save interest over the life of a loan. When you look into refinancing to a new private loan, the length of time that you commit to, is it a 5-year loan, is it a 10-year loan, is it a 20-year loan? Obviously, the further out we go, the higher the interest rate we'll see. Also, could we grab a variable rate, or is it going to be a fixed rate? A lot of times on the websites, you'll see a range of interest. Look at, for example, the 5-year loan on this slide. You might see a range. Well, the person with the least amount of debt and the highest credit score would get the more favorable rate versus someone with a higher debt burden and maybe a possibly questionable credit score might only be eligible for a higher rate. So what would the considerations be? Well, if we have high interest rate private loans, again, you're not getting these forgiven, so let's see if we could get them to a lower rate through a refinance. Could we afford a higher monthly obligation? Maybe we're married, we have a spouse with income, or we're into our contract years and we have some good income. If we can afford a higher payment, let's see if we can get a lower rate as well. If we're not eligible for public service loan forgiveness, well, we're going to pay these loans anyways, let's get them to a lower rate. Even if you have federal loans that are eligible for loan forgiveness, if you have a lower balance, rough rule of thumb is, let's say, under 100,000, you weren't going to get the loans forgiven because the length of time it takes you to get to loan forgiveness, you probably would have paid the whole thing off yourself. So as a result, let's see if we can get to a cheaper loan. Or if you really want to be aggressive, live like a resident as an attending, as they say, and throw a lot of money at your loans anyways, well, let's also look to see if we can get a better rate and save even more. So there are reasons why we would consider going with a private refinance, even if we have federal loans. Now at this point, that's what I was going to cover, as a quick summary on loans. Would take some quick questions.
We're going to unmute the call, and if anybody has questions, you can go ahead and ask them now.
Hi, so I have a quick question. I'm a little further in my career, but the loan company that I'm with now recently told me that they will only take out of my account the minimum required payment for the loan repayment. I can't set it up to overpay each month to pay it down. Is that a new law that I missed somewhere, or are they just being a pain in the butt?
I'm going to lean towards the pain in the butt. It was this like within the past week they told you this, because I think they might look at it as a way to reduce your obligation.
No, this was a couple months ago, so.
They're just being a pain.
Okay.
It might be hard to set up an automatic overpay every month versus you having to log on each month and sending in extra. Do look at your rates. You might be able to refinance to a different company and get hopefully a lower rate, especially with rates these days. But no, customer service on the student loan servicers are usually
Thank you.
Yep.
What do you think about paying on the principal versus paying the tax on it on a private loan?
Didn't catch the second half of that. You're asking about paying additional on principal?
Paying back on the principal versus paying on the tax.
Actually, if you could say that one again.
Sorry. So what do you think about paying back on the principal versus paying on the tax?
Well, typically your loan would have principal and interest.
And the interest, sorry, that's what I
No
meant.
problem. No problem. With every loan, could be a car loan, could be a mortgage, could be a credit card, whatever. All the interest has to be paid off first before any principal gets reduced. Now, with a car loan or a mortgage, generally your monthly payment actually does pay off all the interest for that month and a little bit of principal. Only really on federal student loans do they let you pay less than the interest based on your income. So that's why the interest tends to get bigger. Everyone wants to pay principal down, but you actually can't until the interest is paid off. If you have multiple loans, let's say you've got 8 individual loans and you send one payment a month, that payment automatically gets split across all 8 loans pro rata. So when you send in additional, you can actually identify which of the 8 loans you want to put the additional amount towards, but your normal monthly payment, you can't identify where it goes. It's automatic. Generally, you would try to put the additional towards the highest rate if we've got multiple loans. But again, even with that, let's say loan number 8 happens to be the highest rate, when you send in extra towards that loan specifically, it's only going towards interest until all the interest is paid off. So it's frustrating because everyone wants to pay the principal down, but you actually can't until the interest is totally paid off.
All right, great. Why don't we continue?
Perfect. Now, as I mentioned, I like to talk about insurance, especially for physicians, because you will be invited to dinners. You'll have, someone might sneak in on grand rounds or a noon lecture, or you get approached in an elevator somewhere. As soon as they find out you're a doctor, they're going to talk to you about insurance, specifically life insurance. Now, there are multiple types of insurance out there. So I'm going to, obviously homeowners is self-explanatory, renters, auto, health insurance. There is a product called an umbrella insurance. What that is, it's not life insurance or anything like that. It's an additional level of liability protection that goes above whatever your auto policy covers or whatever your homeowner's policy covers. You're a physician, you're going to get sued. I'm not talking about malpractice. You could be an offender bender somewhere. Your malpractice coverage isn't covering that. But for example, you're in an auto accident with someone who's uninsured, broke, and unemployed, chances are you're not going to sue them because they don't have anything. But when they find out that you're a doctor, you get sued. Now, your auto policy will cover you up to the limits on your policy. If a judgment goes against you for above what your current auto policy or homeowner's policy covers, you are personally responsible for the rest. An umbrella policy is designed to go on top of your auto or homeowners to give you additional level of liability protection. Umbrella policies are relatively cheap to own. What makes them expensive is they would mandate that your auto coverage be at the highest level of liability protection, or that your homeowners be at the highest level. So if you currently do not have an auto policy with the maximum liability limits, and you're forced to raise those liability, your auto policy gets more expensive. Now the umbrella policy on top is very cheap, but now your auto policy is what got rose. But you generally want to have more coverage in case you do get sued. And again, this is not a malpractice issue, but I wanted to touch on these insurances first. But really, I wanted to dive into life insurance. To be very blunt, what life insurance is, someone dies, a check shows up in the mail. Now, there are 2 broad categories of life insurance: term insurance and permanent insurance. The permanent policies are either what are known as whole life or universal life, but I'm going to start talking about term. The reason why a person would have life insurance on themselves is in case they die prematurely, a check shows up so that the survivor can do what maybe we set out to do initially: put that young child through college, be able to stay in the house that we just bought that they could not afford on their own, possibly pay off some debts, could be taxes, could be some, fund a charitable thing or anything like that. That's why we have life insurance, is so that the goals that we set out to do, there's the financial resources to be able to handle that. Now, there are a business use of life insurance. For those of you going into a partnership type of a situation, partners would have life insurance on each other as part of what they call a buy-sell arrangement. Picture this. You're a doctor, you're in a 6-doc group, you're all partners. You would have life insurance on each other. So that way, if someone dies prematurely, and it's now a 5-doc group that has a partner as the estate or the widow or widower who can't practice medicine. Well, because the partners had life insurance on each other, they now have the checks to pay off the estate. And then they would bring in another practitioner. So there are business uses of life insurance. What I'm talking about tonight is the personal uses. If you do not have anyone that is financially reliant on you, or there's no goal that you really want to be seen through, such as a charity or something like that, then there might not be a need for life insurance right now, but in the future there would be. When I mentioned term insurance provides coverage for a length of time. You hear the phrase annual renewable term, which just means as long as you keep paying the policy, regardless of your health, it stays in force. What you would look for is what's called annual renewable level term. That way it's the same price each year. Once you get past that length of time, it could be a 10-year policy, 20, 30-year policy, the price is based on your age at that time. If it's annual renewable, it can't be canceled, like I said, regardless of your health condition, as long as you pay the premium every year. It's the lowest cost of insurance for the amount that you need. Now, these are really old charts, but you can see that as a person ages, the cost of insuring them gets higher and higher and higher. That would be that annual renewable. But if you get a level term policy, lock it in for 20 years or 30 years, it's more expensive in the early years, but it's a lot cheaper in the later years, but at least it's one price the whole way through. You can budget around that rather than have it constantly increasing. If you only need the death benefit for a limited period of time, term insurance covers you. It's the most affordable cost per amount of insurance. If you can't afford permanent, and you'll see how expensive permanent insurance is, you can get a term policy that can be converted to a permanent policy later on when maybe we can afford the premiums at that point. Now, the permanent insurance, primarily you're going to hear about whole life insurance. It provides coverage for the entirety of your life. You make an annual premium payment. That premium pays for the insurance. It pays for the sales commission to the insurance agent. And the rest actually builds up in what's called a cash value. There's an asset there. So a portion of what you pay actually goes into an account that you could potentially borrow against. That asset inside the account grows. It grows very slowly, but it does grow. And sometimes you could use part of that value to pay for the policy in its later years. Now, the death benefit on that whole life policy is exactly the same from the beginning to the end. Early on, if someone dies prematurely, that's a very large check coming from the insurance company. But later on, the insurance, that large check is made up a lot of your own asset coming back to you and very little from the insurance company. That's how they're able to keep one premium price the entirety of your life, because the insurance itself gets very expensive, but the amount that the insurance has to fill, that gap between what the account is worth and the death benefit, since they're not insuring that much, it's still very expensive. So whole life builds up a value inside the account that you could utilize through loans, not withdrawals. So the sales pitch that the insurance agents will present you with, they will say, oh, fund your kid's college with life insurance. What they are saying is, when your child hits college age, you simply borrow from your life insurance policy to pay the tuition in those years. So it's a very long process to build up something of value. It's also a very expensive way to go. Now, there might be a use for life insurance longer than term. For example, if we have a special needs family member that we want to take care of the entirety of their life, not yours, again, because they're going to outlive you, you need life insurance to help take care of them should you no longer be around. If you want to spend down your entire amount of savings in your retirement years, but you still want to leave an estate to a beneficiary, life insurance can solve that problem. If there's other estate planning uses and so forth, life insurance, as I said, builds up that cash value. There's no tax on that cash value. There's no tax on the loans against that cash value. So it actually could be an asset to use for funding certain things. Term insurance doesn't, it ends at the end of its term. If you keep it going, it's very expensive, but it's designed to end. There's no asset in it. Whole life, there is an asset there, a very slow growing asset. You can see the price differences using, for example, male or female age 30, the death benefit, whether it's 250,000, 500,000, 1 million, you can see what a 30-year term policy would cost per year versus a whole life policy is almost 10 times as much. A good chunk of that premium on that whole life policy is a commission to the selling agent. So if an insurance agent has a preference, they would love to sell you a whole life policy. They will make a bigger sales commission on that policy. If you couldn't afford it, they might lower the death benefit on a whole life to get it to where you could afford to pay for it, but now you're underinsured. So we have to be very careful when we go to buy insurance that it's the right insurance and it's the right amount of coverage for what your needs are. For example, let's take a $205,000 a year income over a 30-year career, even with a raise, that's over $9 million of income. That's a lot of future income that if you die prematurely, that income's not showing up to put that child through college, to pay off that house, to fund the survivors' retirement plans and things like that. Now, if we look at the net present value of that 9.8 million, we would need a check of 3.9 million today to replace all that future income. So generally for physicians, you're going to see very large life insurance policies because again, we're trying to replace potentially a good chunk of future income. I'm going to switch gears a little bit, talk about disability insurance. Disability insurance is different than life insurance. Disability insurance is you're still alive, you just are unable to work and therefore earn an income. Now, you get disability insurance through your employer for very large employers, definitely during your residency years. And those of you that are med students, you have a policy coverage through your school. But if we're joining a small practice, they might not have disability insurance as an employee benefit. Through the group policies, everyone gets it, so it's not based on your medical condition. The coverage can be modified or canceled by the employer. You don't have control over it. Any benefits that you receive from the policy potentially are offset if you start earning other income. You might not be working in your specialty, you might not be working in your chosen profession, but if you have another source of income coming in, that group policy is not going to pay you as much. And if the policy was paid for by the employer, any benefit you receive is actually taxed. You don't own it, so you move from employer A to employer B to employer C, it doesn't go with you. We get to an employer that either doesn't offer it, and where now our health condition isn't as good, we might get turned down at a later date. So generally, you do need to have your own personal policy and not rely on group coverage into your career. If you have an individual policy, the benefits can't be canceled on you. They can't be changed. Again, you bought the policy, you locked in your benefits at that time. The cost of that policy could be guaranteed at that time. Benefits generally are not offset by other sources of income. Even though you can't practice your career, you could potentially have another source of income. Doesn't matter. You're going to receive the benefits that that policy says. Because you paid for that policy, the benefits are received tax-free. Even though your health may deteriorate, the policy is still in force, even if you move from employers to employers. So the policies need to have strong provisions in the policies based on your specialty, based on your career earnings and things like that. You're going to hear about a lot of different terms, whether it's a monthly benefit, that's how much you would receive if you cannot work. The benefit period, does it go to age 50, 55, 60? Is it cancelable? The elimination period would be before it would start. If you're disabled today, you might not start receiving benefits for 90 days. Is it based on your own occupation? Are there future increase options so that as your income rises, could you elect to receive more coverage? Is there a cost of living adjustment? That, you know, $5,000 a month today sounds great, but 15 years down the road, $5,000 a month might not do it for you. Are there limitations based on mental or nervous or substance abuse, things like that? Does it have a residual benefit, which means, you know, you're out of work quick, but you get back into the workplace gradually. You want to still be able to receive at least a partial benefit if you go back to work part-time. Is the premium that flat level, or does it start out lower than level and, you know, grade itself above it? Most common reasons why people go on a short-term disability claim: pregnancies, musculoskeletal. You guys understand this stuff way better than I do, but there could be any number of reasons why a person can't work. You could be at PT one day a week or dialysis or whatever. If you're not working as much, your RVUs and your production drops, your compensation may drop as well. Disability insurance is designed to replace that. Most common reasons for long-term disability claims, you can see the percentages, complications and so forth, mental health, sprains, pregnancies, cancers, and so forth. So these are all statistics that the insurance companies know. Disability insurance is very strictly medically underwritten. They will look back through your medical history, more so than life insurance. Are you uninsurable at this point? Have you had a recent needle stick, abnormal blood chemistry? Are you on certain prescriptions? Are you diabetic? Have you had any soft tissue issues that have been treated? Cancers, family health history, seizures, and so forth. So if you do have, let's say, a health history of some sort, you would want to talk with an agent. You would want to talk with what's known as an independent agent. That way they can look at multiple companies to see which is the best company for you, versus a captive agent can only sell you policies from that company. They can't shop it around as much. You guys can look through this list and obviously identify your own health concerns. I'm going to take questions now on the topics of insurance.
Great. Anybody have any questions on insurance? I have one quick question. How much umbrella insurance do you usually recommend that people have?
I'd like to say about $1.5 to $2 million. You know, just that MD or DR for your name just makes people very trigger happy as far as lawsuits. My wife and I, for example, have a pool in our backyard that puts us more at risk for someone being at our house and potentially being injured. So we have, I believe, about $2 million of umbrella coverage on our, you know, just to cover us in that case.
And thanks. And my other question that I often hear is, when, kind of in the physician life cycle here, you know, residency and early career and so on, when should people get, let's say, term life insurance, and when should they get disability insurance?
Disability insurance, generally, for those that are in good health, I would like them to get a policy during their residency. Generally, if we're looking at internal medicine, you know, end of PGY2, going into PGY3, because at that point they're either thinking about subspecializing via fellowship, which I would rather they get the policy before they're into that specialty. Other reasons, if we had a health history, I would talk sooner rather than later. Some states, you know, insurances come under states. So if we're thinking of moving to, let's say, California or Florida, Pennsylvania is much cheaper. So you would want to lock in your rate before we get into a state that's a higher cost. But generally during residency, you're given a discount. and then you pay the discounted rate the rest of your career. If you wait till you're an attending, you're now paying full price the rest of your career. So generally during the residency years. Life insurance, if we are having that conversation to say, hey, let's start a family, you would want to have the life insurance in place before the child is born, in case there's any complications during pregnancy or anything like that. If we're buying a house where we have a financial obligation that we're committed to, generally that's when we start talking about life insurance, because there's this, not only we're trying to replace income, but we're also trying to pay off possibly a mortgage or things like that. But if we have, someone who's single and is renting, there's not a big need for life insurance. You would get a group life insurance, maybe 1 times your salary through your workplace. That's enough, for your family members to, pay for your final arrangements and things like that. But if there is someone, like it could be a younger sibling or a nephew that you really want to take care of, then we could look at life insurance. But generally, for a married couple, if we have that dependency, whether it's, we're relying on their income or they're relying on our income, there's the need to have life insurance. Now I'm going to jump into the next part, the fun stuff, investments.
Yeah, something.
This is kind of an abbreviated version of an investments lecture I do. I always talk about, let me go back, savings versus investing. We're going to talk about the investor behavior, but most importantly, the types of accounts. That's usually what trips people up. Now, what I'm talking about savings, we're talking about emergency needs. It needs to be very liquid, which means you have access to it, be able to redeem with no reduction in value, very little risk, very safe, very stable. Investments are for longer time frames. There's that potential for growth. There's also that potential for loss. There's generally fluctuation in value. So 2 broad categories. For savings, we're talking about bank products. We're talking about money market mutual funds, possibly savings bonds, fixed annuities, things like that. When we're looking at investments, we're talking about stocks, bonds, mutual funds, the market, could be real estate, some life insurance type products such as variable life, variable annuities, and even fixed annuities. It's a very safe product, so it could be in either category. When you are going to invest, you need to think about the goals. You need to think about the time frames. Is it a short term frame? Is it a medium term time frame? Or is it a long term time frame? Example of long term would be to provide for your retirement years way down the road. Medium term might be, oh, I want to pay for my child's college, and that's in 12 years or whatever. Is it very short term? Now there's the time frame until the funds are needed, but there's also the time frame of use. Are we redeeming something in 12 years when the child starts college, and we're going to redeem in a very short period of time, such as just the 4 college years? Are we retiring 25 years from now, but we need to provide for all 30 years of retirement? I've had clients that just wrote 1 check as a fee, gets them admittance to a continuing care facility. They don't have to pay for another dime. So that was just 1 check, 1 day. Others, they're paying for the retirement every single month throughout their, hopefully 10, 20, 30 years in retirement. So the time frame until something is needed, and then how you're going to use it over time. Obviously, the longer we wait, the harder it is to get up there. The types of accounts, definitely want to jump into this. 2 very broad categories. Accounts that you use are either taxable or tax deferred. What I mean by taxable is any activity in that account, interest, dividends, capital gains, they show up on your tax return that year and you pay tax on it that year, each and every year. If it is a tax deferred account, any activity in that account could still have those interest, dividends, capital gains. They do not show up on your tax return that year. Eventually they do, but if it's tax deferred, it doesn't show up on your tax return. Taxable accounts could be just an account you open in your own name, joint with your spouse, anything like that. Trust accounts for minors, custodial accounts, things like that. Examples of tax deferred accounts would be things such as 401ks, retirement plans through work, college funds, healthcare savings accounts, believe it or not, And believe it or not, life insurance, it's not an investment. It will be pitched as an investment by the insurance agent, but they can't call it an investment. Gotta plug my PC in here. Now the 401ks and IRAs, these are examples of retirement accounts. But you might hear of a Roth IRA or a Roth 401k. Well, if it's the traditional version, 401ks, 403bs through your employer, or a traditional IRA that you set up yourself, you can claim a tax deduction that year for the amount you put in. It's tax deferred, as well as the money's inside the account over time, but then you pay tax when you take the money out, typically in retirement. The Roth versions, you do not get any tax deduction on the way in. It is tax deferred the entire time it's in, but then when you go to pull the money out, typically in retirement, there is no tax. So you either got the tax deduction up front and pay the tax on the back end, or you did not get the tax deduction up front, but it's totally tax-free on the back end. Now, your retirement plan through work, the 401ks, 403bs, you could potentially borrow from that account as long as you're still working there. If you withdraw money before age 59 and a half, there's generally tax and penalty. Once you hit age 72, that's new for this year, once you hit age 72, you must start taking money out of that account. There's a $19,500 a year limit on the employer plans. I have it in red there because that's a number that generally changes each year. And this year, currently, it's $6,000 a year for the traditional IRA. The Roth version, if it's a Roth IRA, you could withdraw from it. I'll explain that in a second. There is a penalty if you take any of the gain out before age 59 and a half. There is no required distribution at that higher age, but we still have that $19,500 limit contributions to the employer Roth 401ks and Roth 403bs, or a $6,000 a year limit on just the normal Roth. Now let's say you have a Roth IRA. There's what you put into the account. You did not get a tax deduction on it. Hopefully the account grows to be worth something larger. Anything you put in, you have access to it any time, whether it's next week, next year, 3 years from now. There's no tax on what you put in, so therefore there's no penalty if you took that money out. Any of the growth on that account, tax and penalty if you take it out before age 59 and a half. These are retirement accounts. But the Roth IRA theoretically could serve as an emergency fund. With the money that you put in, you have access to that contribution at any time. Again, you would want to contribute to the Roth IRA when you're eligible, and you'll talk about that in a second. You could convert an existing traditional IRA into a Roth, but you would pay tax on that traditional IRA. I'll show you how not to with a backdoor Roth. With your employers, they might have what are known as matching contributions. You're the employee, you're putting in a percentage of your money. So you can see on here that at that salary, 8% a year comes to $1,300 a month is what you're putting in. Give it a rate of return, and you could have 1.3 million or 1.9 if you got raises over your career. If your employer has a match, let's say 50 cents on the dollar up to 4%, you're putting in 8%, they're putting in 4%. Obviously, your account balances are going to be much higher because you're using your money plus the employer money. Now, the behavior, I always talk about this. People generally, they invest more when things are doing well. They sell when things drop, and this is the wrong thing to be doing. Over time, the markets go up. The before part of this graph that you can't see was the dot-com bubble in the 90s. There was the crash. Then you have your real estate bubble there in the middle of the page, and then the crash. And we're currently in the liquidity and commodity bubble that, depending on who you ask, might be crashing as we speak. Now, investments have a nice rate of return to them, but investors don't realize those returns based on their own habits. They sell at the wrong time. They don't, get into the market and things like that. So how do we mitigate against that? Well, if we have that long-term perspective and we potentially diversify across different asset categories for a smoother ride, you're more likely to stick with it. What I mean by asset categories, we've got stocks, which you hear about on the news. There's also bonds that perform differently. Cash is very liquid and safe, but it is a different asset class, and people get into investing in real estate and commodities and so forth. The more investments that you're in, the blended portfolio, so to speak, would have a smoother ride. Now, over time, you can see this is not up to date, but that blue line represents a person who would be 100% just in the stock market. That green line represents someone with a blended portfolio. Yes, it fluctuates up and down, but not as severe. So if it's not fluctuating as severe, especially in the down times, we're more likely to stick with it. Now, stocks do outperform over a long range, and you can see here's the past 5 years. So stocks have outperformed that blended portfolio. And then we look at something a little bit more recent. You can see that tail there at the end. That's this past month. Or more importantly, here's, let's say, the past 6 months. So you can see how high everything ran up and then how quickly it came down. Usually it does not drop that fast in such a short period of time. So how do we go about doing this? Well, make a plan. If you've got a budget and you can afford to put money aside towards investments, let's do it over time. Keep it simple and coordinate your accounts. You're going to see lots of pie charts. If we're very aggressive, then we have more of our investments in aggressive stuff like stocks. If we're very conservative, then we're going to have more of our investments in more conservative or milder types of investments like bonds. As we age, we might get more conservative because we're getting closer to the period of time where we need to withdraw money. You can obviously invest through lots of different companies, the name brand ones like your Merrill Lynch's and Morgan Stanley's. You can do it through apps and so forth. There's lots of things you can individually invest in. Obviously, stocks, bonds, mutual funds you hear about, but there are things such as limited partnerships, collectibles, Bitcoin, hedge funds, things like that. Now, I talk about mutual funds because generally people invest through mutual funds. A mutual fund is a collection of investor funds used to purchase investments on your behalf. You get a share of the fund and it's priced at the end of every day based on what the overall fund is worth and how many shares you have. It's managed by someone else. It could be very narrowly focused and it only invests in one type of thing, such as US stocks. It could be very broad and invest in multiple things. It can follow a set list. That's what's known as an index fund. There's no discretion. They just simply buy the list and call it a day. Or it could be active, where that fund manager is figuring out, well, I want to own Ford, but not GM. Whereas if it was a passive fund, it would own both Ford and GM. It could be growth oriented, which means it invests in companies that are constantly trying to come out with new products, and therefore they're constantly reinvesting. Or it could be value oriented, which means they have a product that sells, and whatever money they make, they pass back to you, the investor, in the form of dividends. It could be large cap companies, which are very, very large, your Apples and Amazons of the world, or it could be very small, where the companies are worth a lot less. Maybe they don't have that new product yet, they're not very established, but they have a lot of growth potential to them. Morningstar came up with what they call their style boxes, and generally people invest in either large cap companies, both value and growth oriented. When you hear the phrase S&P 500, that's the entire large cap marketplace. About 75% of the US value is just in those large cap companies. Mid cap and small cap make up the other 25% of the stock market. So those large cap companies are extremely large. Costs are obviously a drag on your performance. You don't want to necessarily pay needlessly on commissions, the per trade cost, $9.95 per trade or something like that. Mutual funds have a cost structure to them. The lower the expense ratio, the more performance you would get. Taxes are a drag. Remember, those value-oriented investments kick off dividends, and therefore you pay tax on those dividends if it's in a taxable account. Again, if it's got interest, dividends, capital gains, and it's in a taxable account, it's going to show up on your tax return, just like your wages would, or rental income if you're a landlord, or partnership payout, and so forth. Here's this year's marginal tax bracket. Think about that income expectation. If we have that $205,000 income, we're up there in that 24 upper, what we got? When you hear about marginal tax brackets, 10% bracket, 12% bracket, and so forth, as your income rises, you're paying 10 cents on the first 9,800 bucks, 12 cents all the way up to from 9,800 up to 40,000, 22 cents up to 85, 24 cents up to 163, 32 cents on those last dollars up to 207. So if you have a $100 dividend and you're in that 32% tax bracket, you just lost $32 due to taxes. Capital gain rates. Well, if we buy something and we eventually sell it at a gain, you actually pay tax on the gain based on what income you have. If you're in that 20%, or excuse me, that income's over 400,000, you're paying 20 cents on the dollar for those gains. If you're in that middle range, you're only paying 15 cents on the dollar on that capital gain. So your income determines how much you pay on the capital gains. What we mean by a capital gain is you bought something and then you sold it. What was the difference between what you paid for it versus what you sold it? Did you own it for a year or less? You're paying your income rate. If you owned it more than a year, like a year and a day, you're paying a long-term capital gain, that lower rate. So taxes matter when you invest. If you're selling multiple things and you net them all together to get to a net gain or a net loss. If you have a loss, it helps offset some income. So losses, we don't want them, but they are useful come tax time. So we try to be tax efficient. We try to do our investments in those tax deferred accounts. For example, we're in that 32% tax bracket. We put in $19,500 towards our retirement plan that's tax deductible. You just saved $6,000 on taxes that year. So those tax deductions matter. Again, you got the deduction up front and you pay tax on the back end, or you did not get the deduction up front and it's tax-free on the back end. Generally, you get 2 out of the 3. Now, what if our goal was to put someone through college? We're not using our IRA to do that. We're not using the Roth IRA. We're not using our company plan to do that. We're not using the annuities and so forth, or our healthcare savings account. Instead, we would use a 529 plan. Or maybe we need to invest for future medical expenses. We would use a healthcare savings account, or to pay for our retirement years. We're not using our college fund to pay for our retirement years. So when we set those goals, ultimately, once we know we have a goal, we can set aside money towards that goal and committed to it, then we go with the account that is appropriate for that goal. If we use the wrong account, we might be paying tax needlessly and or penalties. If we use our college fund to pay for retirement, we have to pay tax on the gain and a penalty on the gain. Yet if we use our college fund to pay for college, no tax, no gain, or excuse me, no penalty. So we identify the goal, we identify an amount that we could commit to that goal, and then we identify the account that would be the right account to use for that goal. Let's look at this long term. Let's assume $205,000 salary, 3% raise a year. We're putting our max contribution into our employer's retirement plan, $19,500. We're working from 30 to 65, yet we plan on living to 95. Let's give it a 5% rate of return. And the industry standard upon retirement is to withdraw 4% of the account value in year 1, and then inflate that dollar amount of withdrawal by a rate of inflation. In this case, I put 4% on there. Well, that contributions over our 35-year career was $806,000 of contributions. But at that tax bracket, we actually saved over $250,000 in taxes to do so. Here's really what you're accomplishing. You can see from age 30 to 65, we're making our contributions. There is a slight bend in that line because for those of us 50 and older, we're allowed to actually put in more per year. That's called a catch-up provision. So you're putting in $19,500 up until age 50, and then you're putting in $26,000 at that point. The account value grows up over time. We retire. The critical mass there is high enough that the account is actually still growing even though we're taking money out, but eventually we withdraw all the way down. Now in this hypothetical situation from age 30 to 65, we're contributing, the account's growing over time, and then in the withdrawal years, we were able to pull out, where's the number on here? $4.5 million through our retirement years. Now, this was just you individually contributing towards your own retirement account, 5% rate of return, which is a fairly conservative number to use. If we had matching dollars, we're still putting in the same 806. We're still getting our tax deduction, but the account grows much higher and with those matching dollars, and we're able to withdraw much more over our retirement years. This essentially is what everyone is trying to accomplish without knowing it. Now, obviously, for those of you that are married, you need to coordinate with your spouse. So as we say, talk with them now or talk to their attorney later. Why would you use someone else to help you? Well, a lot of people want to hire an advisor. What do we want them to accomplish? Do we need help with investments? Do we need help with taxes? Do we need help with planning, estate planning, insurance planning, and so forth? So there's usually a mismatch between what the person wants to hire an advisor for versus what that advisor can actually deliver. A lot of people ask me, who I recommend, and the first question I always ask is, well, what are you trying to accomplish? Is it a legal matter? We go with an attorney. Is it a tax matter? Maybe we go with an accountant. Is it an insurance matter, risk protection matter? We go with an insurance agent. Is it investment management? Then we go with an investment manager. So you got to line up what you're trying to accomplish with who's the right person to deliver that specific advice. What licenses and training do they have? What experiences do they have? What level of service can they provide you? Is it self-directed? Is it a lot of hand-holding? Or is it they do it for you without even asking your permission? That's called discretionary. How are their fees charged? Are there any conflicts of interest there? What titles? I mean, there is no regulation around titles. Anyone can call themselves a wealth manager or a planner or chartered this or credentialed that. What initials do they have after a name? I'm a certified financial planner. I'm also a chartered life underwriter. At one point, I stopped paying the fees. I was a certified college planning specialist and so forth. There's many designations out there. They each have their values, but some of them are more valuable than others. I mentioned Roth IRAs previously. You have to be eligible, which means you have to have income or your spouse has to have earned income. You can see at the bottom there, if you're single or married filing taxes jointly, if your income is below that range, you can put in the full amount. If your income is in the middle of that range, it's phased out. So you can't put in the full amount, but at least you could put in a little. If your income is above that range, you can't contribute at all. Notice married filing separate's not on there. I have a lot of graduates that file married filing separate for student loan reasons. Well, they're ineligible for Roth IRAs in that case. So as a result, we have to do what's called the backdoor Roth IRA. This is kind of the last thing we're going to talk about tonight. For those with income above the phase outs or filing their taxes married, step one, you make a contribution to a non-deductible traditional IRA. In the past, when people put money into a traditional IRA, they would take the tax deduction that year. What I would be suggesting is put the money into the traditional IRA, do not take the tax deduction. Therefore, that money is after-tax money. Step two, simply convert that traditional IRA to a Roth IRA. Since the money was already taxed, you didn't take the deduction, so therefore it's after-tax money. When you go to convert, there's nothing to tax. So it took us 2 steps to get the money where we wanted it to be. That's what's called the backdoor Roth. It has been blessed by the IRS. It is a legitimate process. Now, I'm going to point out about we should not have other traditional IRA products when we go to do this, and you'll see why in a second. Let's say you're leaving employer A, moving to employer B, and you have a retirement plan with employer A. Do not roll over that money to a traditional IRA. A lot of advisors will tell you to do that. I'm saying don't. Instead, transfer that account to your new employer's retirement plan. That way the money never was in a traditional IRA. So when you go to change employers from employer A to B to C, throughout your career, you've got 5 options with old retirement money. You can leave it in its existing retirement plan where it is, as long as there's a certain amount. You know, if it's under $1,000, chances are they're going to make you take it. But let's say there's a significant amount, you can always leave it in that plan. You're limited to the choices in that plan, and you can't borrow against it, nor could you add to it, but it's still your money. You can, you know, manage it within the account. What I would be suggesting is laterally move it to your new employer's plan. We go from employer B to employer C. They have a retirement plan. You're going to contribute to that plan anyways. Simply move the old plan into the new one. You could roll it over to a traditional IRA. That's what most advisors are going to tell you to do, but I want you to avoid that. You could convert it from that old retirement plan to a Roth directly, but you're going to pay tax on that conversion. If it was pre-tax money, you're going to pay tax. You're in a high bracket. You don't want to be paying tax at this time in your career. The fifth option, you could always withdraw it and spend it. That's the worst option, but it is an option. It's taxed and penalized. Here's why I'm saying don't roll it over. We're trying to do the backdoor Roth IRA. Step one, we put our money into the non-deductible traditional IRA. Step two, we convert it to the Roth. So we got the money where we wanted it to be. However, if you changed employers and you have money in an old rollover IRA and you put your new money into a non-deductible traditional IRA and you go to convert the non-deductible traditional IRA to the Roth, the IRS is looking at all of your traditional IRA products together to determine how much of those dollars get taxed. So let's say we have $10,000 in that rollover IRA. It's pre-tax, it's never been taxed. And we put $5,000 into a non-deductible traditional IRA and we convert those $5,000. Well, the IRS looks at all the traditionals and say, oh, 2/3 would be taxed when you go to convert it. So it messes up the backdoor process. Now I did list SEP IRA on there as well. For those of you that do moonlighting or have independent contractor type income and you go to your accountant, a lot of times your accountant's going to suggest that you set up what's called a SEP IRA. It's a personal retirement plan that an independent contractor can set up. It's very cheap to do so and you get tax deductions. But it is actually a form of IRA. So if we do have a SEP IRA, that would mess up this process as well. Instead, what I would be suggesting for the independent contractors is to do what's called a solo 401k. It would be your own employer retirement plan, not a personal. So therefore, it wouldn't show up when we're talking about this process. So that was a very quick way to explain a backdoor Roth. Put your money into the non-deductible traditional IRA and simply convert it to the Roth IRA. You would do that each year. You would do step one and then you would do step two probably a week later. Because step one, the money's cleared, it's good to move over, and the account hasn't fluctuated in value too much. Any questions on the investments?
Any questions? I know we had a couple in the chat.
I actually have a quick question because I'm trying to understand. If you do that every year, where you convert to the Roth, don't you end up with a whole zillion bunch of different little investments? I'm not quite following that.
No,
don't you end up with a bunch of accounts then?
Yep, no, great question. Basically, you set up the traditional IRA first, and then you convert to the Roth. You do that. In year number two, you would convert to that same Roth. So really, you only need one Roth. For the traditional IRA, if you use a company like a Fidelity or a Vanguard, one of those large companies, they'll leave the traditional IRA open. It just won't have a balance in it. The account number was already created. So year after year, you're simply making your annual contribution to that same traditional IRA each year, and you're simply converting to the Roth that you would set up the year before. So it keeps the number of accounts to a minimum. It's very convenient if you do it at the same company. So if you have a Fidelity IRA, do the Roth at Fidelity, or Charles Schwab, or Vanguard, or E-Trade. Any company you're doing. I always like that people combine their accounts with just one company. It makes it easier for you to manage. But you're not setting up a new Roth every single year. You're just simply getting money into the existing one year over year over year. Any other questions on the investment side?
So that's great, Michael. Thank you so much. If we don't have any other questions, I know we ran a little bit late, but I think that was some good information.
It's stuff that you need to hear so that as the time comes, not everyone's going to run out and invest later, things like that. But when you set up that goal, it could be that college fund, it could be that house fund or something like that. We need to budget appropriately to set aside money towards that goal. And if we can commit to that goal, then we pick the right account for it. If we can't commit, like we know we're putting money aside, but we might end up using it for something different, then maybe we don't commit it to specifically a college account. That way we have the flexibility. If we needed that money for a different use, at least we wouldn't be penalized for using it for a different use. Same thing with the healthcare savings accounts and so forth. So it's kind of a step-by-step process. We identify what our goals are. We allocate a certain amount of our budget towards that goal, and then we get it into the right account so that it minimizes the taxes that you'd be paying on that investment each year up until that point. I put my contact information up. Honestly, anyone, if you have questions on stuff that I've mentioned, stuff that I did not bring up, you can always shoot me a note to say, hey, Mike, I listened to your seminar, I was at the webinar. Here's what I'm hearing. What does it mean? Or how would I approach, X? It could be about the student loans, definitely on the insurances, if you want that kind of second opinion type of a thing, or stuff you're seeing. Now, I didn't talk about the stock market for this past couple of weeks. We're in very interesting times right now. But hopefully you have a long-term perspective on everything.
Well, thank you very much. And again, this will be posted on our website. So if you do need to review this a second or a third time to get all the nuances, I wouldn't blame you. There's a lot there, but I think it's very useful information. And Michael Clancy, thank you again for joining us. I think it was very helpful. Thanks again.
Okay. You guys all have a great night.
Good night, everybody.